Hey everybody, welcome back to Cover Calls and Short Puts. My name is Mike Fairborn. Hope you had a fantastic weekend. Folks, today I did want to take a look at a couple of different covered calls, kind of potentially, layering in or rolling into the call itself, as well as a buy ride. Of course, we have plenty to look at in terms of our own existing paper money portfolio. Looking forward to going through that with you. Some adjustments to be made, some interesting ones at that. And so look forward to it very much. Folks, welcome Ray, Greg, Paul, William, Jay Richardson, David Trezell. Great to have you on board. I'm joined in the chat by my good friend, Jay. I was going to say, I'm sorry, Brent Morris. I get used to saying James Boyd. He covers for so many classes for me, but Brent Morris is a great friend of mine. I've known Brent for a number of years, at least back to '07, I believe. So although Brent and I weren't as friendly as we are now, we chat quite a bit more. We just didn't know each other back then. But great to have Brent on board. Folks, any questions, comments you have, throw those into the chat so we can address those for you. And I will look forward to any questions coming through as well. If there's anything visually I can answer for you specifically, just make that question out to me. I'll try to keep an eye on it so I can address that for you. Welcome to you, Lisa and Jenny, and it all that's here. Let's go ahead and get started with some of the disclosures that we've got for our class before we get going here. So wanted to note quickly that options do carry a high level of risk. They're not suitable for all investors. Now, information here is for general information purposes only. It should not be considered an individualized recommendation or endorsement of any particular security chart pattern investment strategy. Well, this webcast does discuss technical analysis. Other approaches, including fundamental analysis, may assert very different views. Investing involves risk, including the loss of principal, and short options can be assigned at any time up to expiration, regardless of any money in the money amount. An ITM option does have a higher risk of being assigned early. Paper money software application is for educational purposes only. A stop loss order will not guarantee an execution at or near the activation price. Once activated, they do compete with other incoming market orders. Now, with a stop limit order, you risk missing the market altogether. Keep in mind there, it does say in a fast-moving market, it might be impossible to execute an order at the stop limit price or better, so you might not have the protection you sought. Now, we're going to dive into that a little bit today. A couple just final notes here as we bring this up. There are risks associated with investing in dividend-paying stocks. A couple stocks we'll be looking at do have dividends, including but not limited to the risk. The stocks may reduce or stop paying dividends. And finally, rolling strategies can entail additional transaction costs, including multiple contract fees, which may impact any potential return. Now, with that, a quick look at the markets here. Let's go ahead and just pull up the markets, generally speaking, big picture, broadly speaking. We're still at that upper channel, are we not? Right there. Let's go full screen so you can see this. But coming up off that upper channel, we had mentioned that sometimes you'll see that with a linear regression channel. You might have a tendency to hold off those levels. We'd actually been bringing that up all the way, I want to say, since Monday of last week, wondering, question mark, would we hold that level? We did hold that level. Now, it's still in line with kind of a general seasonality that we might get in the markets, and that is the possibility of a slow drift towards the end of the year. We don't know the extent of how high that will be, but we can say that some of the regular companies that might be kind of heavy on the discretionary side have been showing strength. In fact, that sector has actually been doing really quite well. I don't want to spend too much time on this, but it does just give us a general feel as to where the markets are, just kind of coming off all-time highs as of, wasn't yesterday, but it was last Friday, so the last market trading day, coming off those high levels. Now, if we take a look at, just turn to the NDX real quick, something very similar here. Although not quite the strength of the S&P above prior highs, we did reach above prior highs, and this is kind of an ascending triangle, which we did spike up above here, and sometimes, you'll kind of drift back down, change some colors here, and you might just kind of hold towards that upper trend line before you decide what to do. Sometimes you might revert back down to the lower trend line. I mean, anything can happen, really. Sometimes you might just bounce off that level. So there are a few question marks here as to what we'll get. I did want to turn, though, our attention to the sectors, because the sectors are a bit interesting right now, and they can really lead us into an interesting areas where markets can show strength. Specifically, here are those sectors right now. In fact, just to make this a little bit bigger, sometimes what I'll do, I will simply just click on up top here and detach it. And you'll notice when I detach that, well, it throws it to my second monitor, but it takes all this stuff off the top of the screen. I double click on it, boom, makes it a little bit bigger. And anytime I can make it quote unquote a little bit bigger, it's nice because we're looking at what, 12 here, yeah, 3, that's 4, yeah, 12 little mini screens that we can zoom in on. But couple of quick notes. I just mentioned discretionary that oftentimes are strong towards the end of the year. Well, they happen to be, it appears to be like the strongest right now. Just really showing some strength at the upside on, looking at sectors specifically in the S&P 500 here. Consumer staples might actually hold it's near this resistance. Now, it's got to get above it to hold support, but staples can be interesting if the markets kind of, and I'm going to say the markets down here, kind of round over a little bit. Now, I don't know if they'll round over. Have the markets round over previously? Folks, 100%. They do it a lot. I mean, they just will. I mean, no trend's going to just stay strong all the way to the upside. Can you see any prior evidence of rounding as I've zoomed into this? Let me just show you a few of these. I would call that a rounded kind of a curve, curvature to the move. That was one too. It didn't pull back down too much. Here's another one. Kind of rounding and rounding again. Now, are we rounding up here? That's the question. We might be, and sometimes if you do round here, it's those other sectors that begin to show strengths, namely, like we just looked at, but like the consumer staples. Consumer staples can be strong. That's kind of a defensive area. Another area that can be strong in this area, and we'll look at these in just a second. I just want everybody mindful of this because sometimes this does happen, and then we revert back to kind of the defensive areas, staples in healthcare. Let me just show those to you real quick. I'm going to go back and just click on my arrow up top here, as you see me at the top. Anytime you have a multiple grid with a number of different charts, just click on that arrow to pull all those charts, or I should say all those grids back up. But if you come over here and take a look at that, that is staples, and staples kind of does have this little hammer, I'm sorry, flag pattern possibly. Then we'll see if we can break out of that. And then down here too, the healthcare area, if I just draw a diagonal line coming down, it's not going to be perfect, but we've just kind of been residing right at it. Now, is this going to be a higher low right here? And just some areas to be looking at for possible covered calls and short puts. That's basically all I've got to say here. Aside from this, we just looked at the NDX previously, the NDX, which is kind of tech heavy. This is the tech sector. And what do you see over here with that NDX? A little bit of a pull back there. Possible mini flag pattern, communication services as well. Watch this. If I right click, scoot on down to maximize sell, and then just simply scoot on over. Now you can see it full screen. Do you see what I was saying? It looks a lot like the NDX, but you can see that clearly technology has been one of the stronger groups. We just made a new high. We gapped above that high right there. There's a gap. Mild, very, very mild pullback here. Possibly, will we hold at this support level through here? Well, perhaps we will. Let me just see if I draw a line. Like we said, there was a prior high there, not to mention here, and I can't even fit that G in there. It's so small, but there is a gap. I'll just kind of arrow it down. Sometimes you find support that will reside in there, and we'll see if that can be something else that moves more positively towards the end of the year. Finally, communication services, boom, right there. Yeah, notice you're holding the high and you're just kind of flattening out here. That could be a positive because you are above the highs. And we have seen a history of, you can go back and prove this to yourself, but yeah, if you just break above highs and you tend to hold these, sometimes a lot of technicians will say, you're trading with the trend and you might just be in a better position for a possible follow through, is what we're talking about there. Okay, well, that's enough just on the general broad market, but hopefully that helps. In fact, for those of you that don't have this, let me go ahead and just share. Hang on, let me just share the script, share the grid, and oh, that's it, easy enough. Where are you? Oh, there we go. So I'll share this. It's not a think script, and so I don't necessarily need to say it's not guaranteed for timeliness or accuracy, but it's just simply charts. And there you go. There's the grid. A good quick way to kind of narrow down when you're looking for covered calls and short puts. All right. You might already have some covered calls in your existing portfolio, which is exactly our situation today. We do have some that I wanted to review in our existing portfolio. I'll go back to our standard charts. I have this set up as just like a gold, any sort of a gold chart. I can pull up anything in here, but let's go into it right now and let's take a look at what we've got. Now, in our it's in our, let's see, monitor tab and then position statement right here. Okay, so we do have some covered calls I wanted to take a look at here. By the way, although we did go into this a little bit last week, we're not talking about necessarily short puts today. I did want to I like to make these adjustments. In fact, when they do come up and we're showing maybe some really possible weakness to the downside, but there's still some some profitability in this paper trade right here. Notice we're down almost 400 today. We had a really good move after we put the trade on. This was a short put, but let's pull up PanW right now and kind of highlight that. So that's a very, very big move to the downside. In fact, sorry, it looks like that. That's not PanW. Now that, my friends, is Palo Alto right there. We talked about this one last week, and it did have a good move from last week's discussion. We ran up higher, right? We actually made a new high, but this is a very, very big, candle to the downside. And sometimes if you get a big bar like this, what you're really actually doing, is anybody here familiar with the bullish engulfing pattern? This is something I kind of picked up on years ago. Not the bullish engulfing pattern per se, but when you have a bearish engulfing pattern, bearish that is when the body of the candle, here's a good example right there. The down candle engulfs, the body of the down candle engulfs the body of the prior day. You see that? Well, we have an extreme example here where we have a multiple day engulfing pattern. We're engulfing 1, 2, 3 thus far. The day's not over yet, but the one thing you can do if something like this were to occur, because it is kind of out of the blue, but we're still profitable on this paper trade thus far, the unrealized gains. But you could try to close this out at the end of the day if, in fact, you close, like the body of the candle does close through each of these bars. In other words, there's an engulfing pattern over 1, 2, 3 days. Does that make sense? I've really kind of zoomed in to show that to you right there. But yeah, you've got, here's, 1, 2, and 3. And it's just a big bar. And if you do that, well, there could be maybe it comes back down to this level here. It's not to say that you couldn't hold on to it, because there could be support there. But for those people that are shorter term in nature, and we're placing short-term paper money trades here, that could be a consideration. I'll show it to you right here. So this is the trade itself. We did the 380. We shorted that last week, sold that put. It's still up 110 positively, but some people might decide to close that there or below a support level, which, by the way, if you come over here and take a look at this, there is support here, a gap, possible gap support here as well. That does point to 380. So something else to think about, isn't it, right there with that big engulfing pattern? All right, we'll see what happens with that one, but that could be determining something you could determine at the end of the day. Now, let's see how we doing on questions. Looks like we're doing fantastic. Thank you, Brent. I think we're all caught up there. By the way, Brent, there's a survey link in the chat. If you have a chance to fill that out, that'd be fantastic. Just 2 questions there. If you find something you like, enjoyable, whatever the case is, I'll read through each and every one of those. I promise you. Those are good places for topic requests as well, if you had any. Okay, thanks for that. While we're at it, the bottom right-hand corner of the screen too, just hit that subscribe button. If you're not already subscribed, we'd love to have you on board. We have over 130,000 subscribers right now. So just as a heads up. But by the way, I did see that. There was a question that came through. Is this normal behavior prior to a split? Now, normally, Jay Richardson, what tends to happen prior to a split right there is about a month before. Now, this is just something that traders will look at. About a month before that split, you tend to get bullishness, but there can be a little bit of a pullback prior to the split. But a lot of times it's just bullishness up to the split date. And then afterwards, it might relax a little bit. The trend's already up, but that is oftentimes what a lot of traders will say happens around a split, right? And you're getting that right there. So it's a 2-for-1. In other words, that would put us close to, well, 2-for-1, 2 shares. So that'd be getting us down to about 200, right? Or something. I'm just kind of eyeballing it. But I don't know. You have to look at the numbers specifically. But yeah, good question. Generally, it's about a month before is what a lot of traders will say. It'll run up, and saw a little bit of that, but yeah, pretty weak in the face of weakness in the general market, I want to say, right here. Yeah. So we're down today too, as we saw, kind of a little bit of rolling in the market. We'll see how that does unfold. All right. So let's continue. We did have a couple more, I should say, to look at here. We did have, so we've got, let's see, GLW was a trade that we put in, a covered call trade a while back. We'll go full screen again, and I'm going to show it to you right now. Now, I think we're doing okay on this, on the paper money portion. We're up actually really, really nicely on these 200 shares. We had a good run and we've held on to it. But what we've done is we've sold covered calls on it over a period of time. Here's another covered call. It's actually down right now. But the covered call itself, we could look and see what we've got on it, because I do know we put on another covered call. This is kind of one of those long ones that the trend's taken a long time just to run up. But we stuck with the trend on Corning. And if you come over here and you take a look at that, there's only 18 days left to expiration. So what could happen, because there's a lot of time decay that's already been taken out of this, a lot of times we're looking for, 20 to 50 days in terms of time. You can see 18 remaining. And let's see if we can maybe try to capture some of these gains. And well, let's see, it's even further out of the money. So we did a covered call. Oh, there is barely. Okay, there it is at 52. So we could maybe close this out and then maybe look to roll the position into one that's a little bit further out in time. Now, why would we want to potentially roll that position? A couple things might come to mind as you look at this. And by the way, how profitable are we on this right now? 110. So the covered call brought in that additional income of 110 thus far. It fulfilled what we were kind of anticipating have happen, and that was what? Remember, we discussed this. I'll just swap up some colors here, and this is really goes to the kind of the bigger picture of holding a long-term position. If we're confident in doing so, and we wanted to maybe sell a call and try to bring in additional premium, we can do that around resistance levels. As you recall, on this stock too, we put in kind of this slope. We said, hey, prices are kind of extending along this range. This is kind of the upper range. Let me adjust that here for us a little bit. It's going to mess up some of my numbers. That's okay, though. You see that right there? So we said, that might have been a resistance point, resistance, because it had been previously through here, 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 and here when we sold that call initially. Now, it turns out that the price of the stock went up a little bit. We still held that 50, which was part of our original kind of plan, that the price of the stock might hold around 50, although we sold, I think, the 52 or so, up a little bit higher above that resistance level. Okay, so we sold that. So we had a couple of things working in our favor. The delta, which really tells us that for every $1 increase in the price of the underlying stock, the option will roughly move up or down by the amount of the delta. Now, because we were selling calls, still the price of the stock went up, but we had time decay over here. We had theta. And the theta worked in our favor a little bit, right? The theta did, because it's getting closer to expiration. There's 18 days left to expiration. But notice up top here, we made gains up to 50. And so the price of calls, in this case, the delta would have been going higher. So I'll just confirm that. Yeah, the delta, we have a higher delta. I mean, the delta is a positive number. So when the price of the stock goes up, those calls would collectively go higher too by the amount of the delta. For every $1 increase in the stock, they would go up by the amount of the delta. The point here being is that the calls now are maybe a little bit more expensive. And that could work in our favor if we're going to do this again. If we want to sell those 50 and see what we can get out of those for the possibility of this. And this is why anybody might look at a covered call in a long stock that you own where you have at least 100 shares of stock, at least 100 in terms of standard equity options contract, a standard equity options contract. And that is this. If you thought that the price was maybe going to kind of stagnate a little bit, go sideways, go down a little bit, maybe go up even a little bit, you could sell the call and then try to bring in income like we just did over here I'll close it out here in just a second, but there are some unrealized gains that we've made on that, right? Now, can we do this again and shoot it over here for the next month and sell another covered call in this paper example? Something that you might, an approach that you may consider in your own account for existing positions as well, right? Of course, you have to have options. And of course, you like to have the liquidity component for sure in there. Liquidity is very, very important, obviously, so you can get in and get out. We still have some of that liquidity on this stock, despite the fact that it is way out of the money here, and it's a kind of a lower price stock out this far. But right now we had actually 2 contracts because we have, we have 200 shares. That's right, we had 200 shares of stock, so therefore we could sell 2 contracts. So what would that do? Let's go ahead and just close that out. Let's go ahead and just consider rolling this out, which simply just means closing our existing short position and then selling another one out further in time to capture additional returns, additional gains, right? Income. So we're going to go out into the future and try to capture additional potential, generate possible income in the future is what we're really looking at. So let's start off with the first part of that roll, and that is to close out our existing position. There are 2 of them. I'm just going to since we're in the trade tab right now, I'm going to just left click right here. This is one way to do it. You could set this up. Oh, yeah, to buy it back, you want to buy back 2 contracts, hit confirm and send. The other way, which is actually really quite easy too. I think many of you have done this, and this is really quite exact. You don't have to adjust the contract size or anything. Just right click on position here, create closing order. It's already got it there for us. That was a right click. Whether you're on a Mac or a PC, wouldn't matter. Right click, create closing order, then left click here. You got it. Okay, I'm going to try to buy this back for the mid. Well, let's just go 20. I think the paper money will give us a generous fill like it always does anyways. Oh boy. We'll go back to where we were. Okay, so there you go. Let's just hit confirm. So we're saying we're buying back these 2 contracts because we'd sold them at the bid initially to collect. There is a cost to do that. It's $40, so we're not going to get the full gain. But it said that was, we're roughly getting maybe 100 to 110. We captured on that. I'll send it through right now, and there you go. Somewhere in that range. Okay, so now what we can do is we can look up top here. Not in this month, but go out further in time and see if we can roll it again. Well, there's our Januaries right there. The January with 39 days left. Because maybe the expectation is, for somebody that owns a stock like this, is that the stock is giving us a little bit of we talked about it, like a bearish engulfing pattern, but it's definitely showing some resistance right near that 50 level, right? Which is we did here. It's kind of one of those round numbers that prices can bounce around. Well, let's just see what we can do on that. Here's that Jan. Let's scoot on down and see what we've got. So if you look at the 37 right here, this Delta 37, now that's a way for us to collect more than just 20 cents, right? Instead of just what we had before, we can collect, well, there's maybe 95 cents at the bid right there, possibly, if we looked at the 50 itself. Okay, because we thought maybe prices are going down. The delta right there is 37. So this gives an approximation. It says that, 37% of the time we might get above that strike price, the 50, by expiration. This does not factor in possible resistance, the possible rolling over of the market. Is there a way for us to kind of capture this short term, for example, within a covered call? Okay. Maybe capture some of that to the downside. Well, what we can do is let's just go ahead and see if we can get a fill on this again. We have 200 shares, so I'm just going to do it again with another 2 contracts. We'll go confirm and send. Let's just read our confirmation real quick, though. So the break-even price is 50.90. Max profits at 180 in this case. Getting a little bit more maybe than the last go around, possibly. We'll see. That's the max. And then you can see it says the max loss is infinite. Now that's not true because we have 100 shares of stock, and that's the covered portion. If this was just a straight up single call, or they refer to that as just a straight up naked call, well, it could be unlimited to the upside, right? Theoretically, it's unlimited because prices can keep going higher. But if we have a call, the stock in there, it is covered. And it picks up on some of that right there on that buying power effect, which is at 0. So it's not, there is no buying power effect here. It's sort of recognizing, I think, that we do have a stock. It gave us 95. Okay, so 95. Now, what else could this mean? It provides a slight buffer for us. It's slight. But if the price of the stock were to go sideways through here, okay, if the stock were to go sideways and we examine that, well, we're about 48.36. I'm just going to use an approximate dollar because we're close to it. So let's just say we got close to $1 here in terms of the premium that we just received, approximately $1. So we're going to go ahead and just say, I'm going to kind of, well, let me just do this instead. It doesn't really give us a number. There we go. So we're at, I'm going to click on this right here. I'm just going to pull this down. You can see it right there. Oh, pull it down to $1, which is about right there. Oh, there's the 95 right there. So it doesn't give us a ton of like a buffer zone, but if you think about it, you're actually, you know, that's, I've just kind of tried to point where the ultimate, you know, level is in terms of where that premium could just, you know, kind of in a buffer sense, offset a downward price move, right? All else equal, if you were to get your max gain, you're giving a little bit of room, giving a little bit of a buffer zone there. So let me do this and just kind of show you what that might mean over here. There you go. That looks a little easier to see. And so it gives you a little bit of room from where we're at. That's not an exact number, but again, if we thought that we might do this still, because that was a big run on GLW, and you thought that, gosh, you know what, it's still going sideways, that's something we could consider. Now, the next thing is if the price of the stock does go up above that 50 level right here. Well, first of all, at expiration with the short call, it's just very likely that you're going to be called away on your shares at 50. So you're not going to be able to make any gains on the stock above 50, very likely, right? Let's just say this. So you're at 48.38. If we own 200 shares of stock, which we do, in order to calculate the maximum gain, if there was kind of an assignment, you know, our shares get called away, prices come up to that 50, we still make gains between the 48.38 and the 50 level, right? We've got 200 shares and we're making those gains to the upside. Plus, what was it, 180 at expiration? You know, you'd want to factor in commissions, etc. But that was the difference. So anyways, I think, you know, all else equal, if our expectation was a sideways move, have we improved the income into our account by rolling it out in time instead of just waiting? Because if we're just waiting, we might make 20 cents over here, right? Collect the max 20. But over here, if we wait just a little bit more into January, it was closer to, I mean, it was like 95, right? 95 cents. And so that's kind of the trade-off there. By the way, one last note I'm going to make on this, because it isn't a consideration. If you wait till absolute expiration, which is somewhere like right here, I'm just looking at maybe like the third Friday, right after the third Friday of the month, or close. Maybe it was the 27th. So it was out here. Yeah, I think it was December 27, 18 days out in time. Let me just double check, because I do want you guys to see this. This is a consideration. I've come into this situation many, many times as I've looked at this. I'm going to point to this using the pointer, and I'm going to pull this over to the number of bars. The problem is it's not giving us the calendar days left. Okay, it was. Look at that. Wait, it was there. I'm sorry. The day's up on top. So it was the 27th. So it was right over here. So look at this example. When you're rolling, this is an important consideration. I've kind of got it marked. All right, I know where that's at. So if the price of the stock were to do the same thing, let's just say it goes sideways over here, and right about there, close to this date, approximate expiration date right there, I'll just put X for that option, you're gathering 20 cents. Now, if we look over here, and it's going to be actually probably very, very close to just the edge of this line for our January that we had just sold, like which was 39 days out in time. Remember, this was the 39. But if we waited for all of this time to elapse right there for 20 cents, folks, do you really think that we're going to be at 95 cents over here? It's going to be likely quite a bit less. Let me just show you quickly how you could determine what that number would be. right? Because you're not just going to be able to sell. Let's get our 20, and now, 20 cents. Let's say if, the price of the stock doesn't go above the strike price by expiration, above that 50 or 52, whatever it was before, and, there's not an assignment of shares, then, uh, you know, we're just gathering 20 cents. But what about that 95? Well, let's do this. What if we just went over here and we're gonna take a look at the and that's like it dipped just a little bit, but well, I'm going to still choose that 95 level. Go over here and go right to this theta column, delta theta. Go over here into the theo price. Now, the theoretical price does take into account a number of these deltas, the option Greeks, I should say. Option Greeks, the delta is one of them. Let's go ahead and make some adjustments here. So let's just say out by the 27th, which was right there, the price of the stock, I'm going to say it doesn't move at all. Okay. I'm just going to tab through this now. Okay. Let me just do one thing. Okay. Yeah. So I can click here. So what would that have been worth actually? Closer to 50 cents now instead of the 95. So it's not quite cut in half, but it's close. Do you see what I mean? If you wait to collect that 20 cents, you've already got that cut in half. So just some considerations. All right, to look at. And by the way, yeah, if the price of the stock were to dip lower, obviously, if it dipped $1 lower or whatever, let's just say $2 lower, minus 2, it's going to be a lot less. That's like 13 cents. So timing is important even on covered calls. So anyways, bottom line is we've made that adjustment. Okay, so now here's a different one that we had in our portfolio. This is WDC. WDC did exactly what we wanted to do in terms of a covered call. In terms of what we were looking at, we wanted to see strength. In fact, if you come over here and look at it, WDC is up. It continued to rise with 200 shares of stock. Okay. And I think the options would have, this is going to be interesting. The option here is, okay, 11 days left for the call. Notice we're already in the money. It is actually down $141 right now because, the original price that we sold it at, it is now at $2.90. So it has gone higher because we're above the strike price. But there's a couple of considerations to look at. What do we do with this at this point in time? We're down a little bit on it, but do we want to give up all our shares? We could still collect the premium here that we received, the original 220, right? We could collect that. But what do you see on WDC? This is just like a consideration. We did make a new high here, it looks like, yeah. And we pulled off to the right. So this is where we really have to kind of conjecture, right? What will we see going forward? Do we want to wait on this and see that if this is like kind of a bull flag? Well, one thing that could be done is we could roll it out again. Does that make sense? We could roll out the position, take that small loss, we could close it out, and then roll a little bit higher and stay and say to ourselves, we still want that covered call on. We're just going to close out the existing one because we're above our strike price by a couple of strikes. And we're going to sell one up higher because look up top here. There is resistance at 80. Okay, and this way, we're just in a better position so that we don't have to, it's just a lot less likely, obviously, that we would get above that strike price by expiration and then get called away. Because right now, we are currently above it. You guys see that? So this is one that's worked in our favor, but this was actually really quite strong. And as you come over here and take a look at this right there, a lot of volume. Now, this is an indicator that we build in our ThinkScript class. I'm going to pull it up right now. It's a combination of both RSI and money flow. And it's just a momentum money flow. That's what I've referred to it as. And it's right here. Oh, so I was going to click on that. There we go. And it just is a combination of the two. So it's got momentum and money flow. Do you see how it's holding above that 70 level right there? It's holding 70. A lot of times, if it's showing strength, you get momentum from the RSI, but you're getting buying pressure. And I think that's exactly what you're picking up on here. It was actually a very, very sharp move to the upside, as you can see right here. And a lot of times, if you're going to get the money coming in, the volume, and a bull flag with a trend, it's kind of a longer term trend, some traders would suggest that they might let it run a little bit longer because they think that the trend could still come up here and fulfill as a, right in that range, is a flag pattern, right? Which is close to the flag pattern formation on this one. So, okay. So if you're putting a paper trade on now, it still could be something you could look at, but I'm going to go ahead and close this one and then roll it to a higher strike out further, taking a small loss, but keeping, right, the majority of our gains intact over here. Because we don't want to give up our stock necessarily, because we think, hey, I mean, if it's going to run up 200 shares, we have 200 shares and it runs up from, let's say, 71 to 80, okay, it's not quite $2,000, right? But you're getting a dollar for dollar move on those 200 shares. And maybe somebody says, I think that's a higher probability. So let's do that. Let's go over here and we're just going to close this out. I'm going to clear out my, we'll reset this. We don't need that right now. We'll buy this back at a loss. Notice the spread, very, very good in there. We'll buy it back right now at, hang on a sec. Well, we'll just right click and we'll choose the closing order because there were 2 contracts in there. Gets it all set up for us nicely. Confirm. You can see up top here, we're just buying that back. It's got some information here, but we'll send that on. And there you go. So now what we can do is we can go out a little bit further in time. There's the Jan again. We can shoot up a little bit higher, still try to collect a premium, but giving it room for the possibility of a gain on the stock, capital gain on the stock, going higher. Here's your 80. Where is our delta? It disappeared when we put that on. 80 is really out here. So right towards the end of where some traders will choose that delta at a 0.2, right? And so pretty decent spread still. Let's click on the 90, the 99 under the bid. That's the 80 strike, giving it a lot of room generally because we're looking, some traders will go between 0.2 to 0.4. This is further out in time because maybe we're bullish on the possibility of a flag pattern again. So we'll click on it right there, 99. Let's go ahead and do 2 contracts again because we've got 200 shares. Take a look at it and send it through. Break even, listed right here. We've got our max profit and credit listed down below. No buying power affected, is recognizing that we're doing a covered call. And there you go. Looks like we got a fill at the mid, which is about $1.04. So we've added this back into our portfolio. We've just kept it going. A couple of different examples, totally different from one another, but hopefully that was helpful because these are the scenarios, that we'll actually run into, right, in actual market conditions. I've run into these same scenarios just a number of different times. It's just good to kind of walk through and see what kind of alternatives there are and what you might be looking at. And a lot of it's just going to be based upon what you think the price of the stock is going to be doing in the future. And then when you have that down, and we chose a bullish in this example, right? Then you go and you turn to your options. You say, where am I going to roll to? At what level? And things along those lines. You don't want to just look at, because sometimes I did this early on. I just looked at the income. I said, shoot, I like to get a lot of that option income. But in this case, if it did unfold, where are we going to make our most gains at? In the movement of the stock. That's what it's been thus far, right? Holding on to this through a period of time as it's run higher here. Yeah. Okay. All right. So now let's add some new ones today. And this is one we've got. This is Abbott Labs. Now, a couple quick notes on Abbott Labs. It just is where this is one of those companies that is it's in the healthcare. We talked about the healthcare being a possible defensive type play. And what's interesting about Abbott Labs is we've run up to these highs up here on Abbott. And we've been holding the 120. Okay. That's where we say stop. I've seen this before. This could be resistance. And I could be considering selling calls up top here, right? Around this level up here. I could consider that because if I think it might still hold around, I think it's still going to be bullish perhaps because I think maybe it'll be a defensive play or whatever the case might be. And you'll notice down here with that, the momentum money flow it is still holding near this level. A lot of times if you're showing strength, you might hold into a certain range. Now, if you start to show weakness and selling pressure, it's to the downside, but the money flow likely influencing this to some degree, but still higher highs, higher lows, generally speaking. So definitely some technical considerations we could look at. Now, where might we look to sell the call? Comes back to the stock. Where do we think the stock might find resistance? Because we already have, I think, 100. We've only got one contract, we've got one share, not 100 shares. Okay. We've got to add 99 shares to get to a round lot. This is a good example. This would not have been a covered call. That's why we're checking in advance. So let's just go ahead and buy. How about this? We'll round it up. We'll go right exactly to 99. That way it's nice and even. 99 shares. We'll go ahead and hit confirm and send. Now, that should have helped us out in terms of getting to a round lot. And look at that. It sure did. Okay. So there you go. 100 shares. Now we can do it. So we could put a covered call in here and potentially try to collect income again. I'll put a $ right in here because that's what we're trying to do, as our expectation is the price of the stock might bounce around. Now, if we thought it was going to show some strength up here very short term, some people could wait and then sell, let's say at the 120, right? We could wait because if we did that, the premiums are likely going to be higher if the price of the stock ran up fairly quick, because you got the delta move in there, right? Influencing the price of those call options. I had the P there for price, but it's the call that we could be selling. I'm going to go ahead and just put one on now, just because, so we can show it. But there could be an expectation of it moving higher. Okay, we're back into those Januaries. Where do our deltas point to right there? So the 120, which is where we were looking at. Beautiful spread right through there, less than a dime at a 24 delta. Let's go ahead and click on this right now. We said there was 100 shares of stock, allowing us to do one contract that's fully covered here. We'll go ahead and just go with our 87 cents, although paper money will get us the mid price, I believe. It's got a few things to look at in terms of break even, although remember, it's just looking at the put by itself, the call by itself. We're looking at a covered call, but just always be mindful as you go through here, in-funded. If you just have the call itself, of course we don't, we've got it covered. We made sure of that. Buying power effect recognizes that there. Okay, so we've got that covered. Now a couple more to look at. I'm just going to throw these out. We might have time to do one of them, but I want to look at IR as another example. Notice IR hitting highs up top here, kind of showing resistance at 105, but look at this. Big number a lot of times, those big round numbers at 100. You test it a lot of times. Look at that. All through there, through here a bit. We got a little higher, but then we gapped above it, right above it, and then we held it again. So there could be some support down here. Could we possibly, on this trade, let's see, I don't think if somebody was looking at maybe possibly a buy right, they could buy the stock and sell the call, right? Another one, Honeywell, HLN. Okay, a good spike. You got past earnings, which the market didn't like initially. I don't know what happened afterwards, what they said on the conference call. Of course, it still probably dipped after that time, but do they have some news? It appears that something happened right there for Honeywell. You could take a look at that, and it seems to be holding that gap level right there too. Holding the gap. If we remove that gap, it looks a lot like a sort of a flag pattern, right? Right there. And so the consideration again is, could it be a flag? And if it starts to move, do I still think maybe if the market rolls over a little bit, maybe there's still some upward gains. Maybe it won't be too strong, but maybe there is some gains in there. And then also the possibility of generating income from that as well by selling a call. So I wanted to leave you with those two. Sorry, we ran out of time on those two. But again, first one was IR, Ingersoll Rand. Remember, these two companies, I've looked at them. They have pretty decent spreads. I think the other one's a little bit stronger on Honeywell, but it's close to 1 million shares there. There's your Honeywell, over 1 million shares, and you're getting a little bit better spread here, but still maybe a 20-cent spread. So a couple to look at, but generally just looking at the patterns there, folks. Hope you found this informative and useful. Great to be back with you. It's a fun class to teach. And love the comments, questions coming through. Yes, I can share that money flow script. Right? Yes, I will right now. Good catch right at the end there, Paul. Again, these are not guaranteed for timeliness or accuracy. And I will have this script in the description section under more under YouTube for those of you viewing this in the archives as well. I did teach a class on this specifically in ThinkScript, so that's out there. But let me just share this right now, and you got it. There it is. Okay, everybody, have a great rest of the day. See you next time.